Welcome. This is the June 2019 edition of the Zacks Ultimate Strategy Session, just one of your benefits as a Zacks Ultimate member. And this month, Kevin Cook and Tracey Ryniec agree to disagree on whether buying Chinese stocks now is a buying opportunity or just too risky given the trade situation. Sheraz Mian and Neena Mishra have the portfolio makeover. Kevin Matras answers those questions from the mailbag, and as always, there's top stock picks and more. But first, Tracey Ryniec and Kevin Cook want to bring you their fundamental and technical market views.
Time for another look at the charts, and we're going to go back to April 8th, the last time I did this for the Zacks Ultimate Strategy Session, because those charts I showed you then are not only still relevant, those same themes, but they're highly instructive to where we are today and where we're going into what could be a cruel summer for stocks. All right, go to my screen here. I showed you the NASDAQ 100 equal weight. This is the First Trust ETF version, QQEW. And here we were on, April 8th, there we are. And I said equal weight had made new high, even though the NASDAQ 100 proper didn't. Remember, NASDAQ 100 is 30% Microsoft, Apple, and Amazon. So it was nice to see the breadth from 97 other companies lifting the market up. And we got that. Then we had this correction. Warned you in May. I was looking for a pullback to 2750 on the S&P. We got that. Here we come again. Are we going to make new highs? I'm not so sure. Let's look at some other things going on. Let's go to the Zacks, semiconductors. I also showed you this. Semis are under a little more pressure because of the trade war. How about software? Here's software, another important chart I showed you, market leadership, and again, indicative of breadth, and big confirmation this morning, Salesforce CRM buys Tableau data for $15 billion. And that's helped us with some of our smaller software plays in the same space, like Domo and Alteryx. But it's just, software continues to be on fire. And if anything, software is going to continue to lead the market higher. Now, I still say it's going to be a cruel summer for stocks, but that means you have to be a stock picker. I don't think the indexes are going to fall apart here on trade worries or whether or not the Fed is ready to cut rates. We'll have to wait for more economic data for that anyway. They're not going to cut here in June. But you got to be a stock picker here. So study software stocks. There's 50 great ones to choose from, and you've got to be able to find some winners there. That's what I'm trying to do for you. Okay, let's go back to the other indication of market breadth. I showed you the big picture view of the New York Exchange Advanced Decline Line, the NIAD. This is a 3-year chart. Of course, I took off the moving averages because we don't need those. So, where were we in April? We were making new highs. This tells you the market wants to make new highs. Here, look at the NIAD again. Now the NIAD is making new highs again. A lot of players watch that. I told you I prefer to focus on the S&P because the NYSE has so much other stuff in it. So let's put an SPX advanced decline percent. And we'll get a similar view. So there it is. After that dip, we had SPX 2750 that I told you was coming. And, we didn't get long there, but this thing's making new highs. I'm sorry, we didn't cash in our short S&P trade, but we did get long. We bought some stocks down there. Wish I had bought more. So does the S&P make new highs this summer? I don't know. It could be a coin flip, but I know that many stocks will make new highs. And those are the ones we need to find in what could be a summer of volatility. All right, thanks for joining me.
So what's going on with the economy? It's a little bit dicier than the last time I came to do this segment, but things are still looking pretty solid despite the recession fears. So the first thing I always look for when trying to figure out economic fundamentals and where the stock market might be going is in the employment. Now, we did get a weak May employment report, so that had everybody a little bit spooked, at least in job creation. But the weekly jobless claims really aren't showing true danger yet. So I brought the chart of the longer term look at the 4-week moving average of the initial claims. And as you can see, it's still down, down, down. It's kind of bottomed out here right around 200 to 215,000 here. That's a 50-year low still. Now, of course, when you bottom out, it has nowhere to go but up. But we would need to get back up over 300,000, I believe, in order for the job market to really show the slowing. And for right now, that just isn't happening. So this is a key fundamental you should be looking at, along with we'll look at the backward-looking indicator of GDP. Now, I brought this longer chart so you can kind of see where we've been on GDP. And even when we've had a couple quarters of a slowdown, that first one in the green was around 2011. That's when we had the debt ceiling issue and the downgrade of U.S. Credit rating and the Eurozone crisis. There was a lot going on then. Greece was going under, all of that stuff. We had a couple negative quarters, but we did have the bounce backs in between there, and there was no recession. And then the last kind of pseudo slowdown was in 2015, 2016, when we had the manufacturing recession. You can see we never even went negative there, but we did see 2 quarters of a slowdown and then came back out of that. And now we're actually, above, or at least holding on to the 3% GDP, although the estimates for the second quarter are coming down now, so we may be, weakening a little bit again here. But this is a backward-looking indicator and can change quite quickly. As you can see in the recession years, we were at 2.5 and then bam, then it was down, down, down. But remember, a recession is 2 quarters in a row of negative GDP. So just 1 quarter on its own doesn't lead you there. And this is something that I do watch along with the employment. But as you can see, we're really just not there yet with what the data is showing. Yes, there's some signs of slowing, and the tariff threat against Mexico combined with what's going on with China is putting some stresses on the U.S. economy. But the companies themselves on the earnings reports are still pretty solid. And that's what you should be watching along with the unemployment and employment. Keep an eye on what the companies are saying, because obviously they're at the front lines. The apparel companies, the retail side is seeing bigger impacts from the tariffs for obvious reasons, but a lot of the other companies are not, at least not yet. So I'm keeping an eye on all of these factors, and I will be in the month of June here as we head through the summer. But keep an eye on those weekly jobless claims, because that can kind of give you a sense of what's going on. And I'll be back again over the next couple of months with another look at the fundamentals. But for right now, the fundamentals are not as bad as they seem. And we're getting a bump here in the stock market, because even if it's not as bad as it seems, the stock market believes the Fed has its back. So it will bounce on that kind of the Fed put. And so that's what we're seeing right now. So it's another reminder to stay invested even when things get a little bit weak in the stock market, as it did in May, because you don't know when we're going to get that bounce back.
Tracey Ryniec and Kevin Cook try to agree to disagree right after this list of recent Zacks Ultimate top movers.
In this agree to disagree, I may not know what I've gotten myself into. I've decided to accept the challenge from our resident China bear to debate her on the merits of investing in China. And I will pass it to Tracey first.
So I am obviously the bear. I'm on the negative side, but I've been negative for a while. But
Yeah.
some of my reasoning has changed in recent months.
Okay. It's not all about shadow banking?
No,
Okay.
and not believing the actual numbers that we're getting
Okay.
from the companies. Now I feel the Chinese government, which I thought had decided to pick the winners, pick the companies that were going to dominate the industries. So similar to our tech companies. So you have Baidu was like the Google of China. You have like, Sina. You have Tencent, which is on the gaming side. Plus they're the Facebook of China too. So they picked these winners. And I thought they would support the winners, that there was no way they would do anything to harm those winners. But over the last 5-6 months, that has not actually been the case. So, for instance, with Tencent, they decided a couple months ago that they didn't like the new video game that they were putting out, and this is one of their huge new releases, and they made them yank it off the market within like a week of launch. And as we saw in Tencent's earnings report, it actually had a big impact on their bottom line. Now you could say, oh, that's just a one-off because now they've loosened that again with Tencent. But I don't like investing anywhere where some other outside entity is basically telling them what they can or can't do. Now you can say U.S. companies are regulated too. Things happen. Certain products don't make it to the market here either.
But not to the same degree.
Yeah, this was literally, we put out our new video game. Oh, now we have to withdraw it. Like that, you can't know how to react to that as an investor. So we have that issue going on. And now with the trade tariffs slowing the Chinese economy, everybody just thought the growth was forever on a lot of the consumer names. But we're seeing, look at what's happening with the auto sales. And I feel the autos are kind of the red flag, even though it might not be quite as big of a red flag as it would be here in the U.S. But we're getting the May auto sales in now. Every month this year, auto sales have been down double digits there. And they've been down, I think, 9 months straight now. And it's getting like a little bit crazy how bad they're plunging. So Geely, which owns Volvo, was just out with May numbers, and they were down 27% again in May.
Okay.
And some people had argued, the switch over to electric cars, the Chinese consumers want the electric cars. The car companies weren't making enough. So they just were saying no to the, gas guzzlers and like buying up whatever electric cars, but there weren't enough. But after so many months of that argument, you have to say you'd think they would have figured it out and started making more electric cars, but they're not. There's been layoffs in the big auto companies and in the city where they predominantly make autos. There's the unemployment rate's gone up there. So I feel like the trade war is impacting bigger than maybe people are thinking it was going to do.
Or more than they'll let on anyway.
Yes, yes, both things. And that puts another key thing in about buying any Chinese company that's especially consumer-based. I feel like you really have to start looking now at valuations and what you're paying for these. And investors for the last couple of years haven't cared at all about valuation because it was growing forever.
All right, well, let me address a few of your points because
Okay.
you made a lot of them. And I wasn't aware of this perspective of, the Chinese companies, the Chinese government picks the winners, but they may not always be there for them.
Right.
So that probably is important on a company-by-company basis.
Right.
And on a country basis, as we just talked about, it's still a communist country.
Right.
So,
It's still a command economy.
dictatorial control, always a risk, right? I'll say, in my perspective, I'm taking the long-term perspective on China as the largest middle class in the world.
Yes.
Right? 600 million people, probably more. And that China won't cut off their nose despite their face. So they've got this huge middle class. I just saw one number this morning when I was looking at the internet advertising company or the digital advertising company, The Trade Desk. Over 800 million people have mobile phones in China.
Yeah.
Which
They're
is
very connected.
more than the U.S. and the EU combined.
Yeah.
All right, so that is the core of that economy. And so they need an Alibaba to succeed. They need a Tencent to succeed. They're not going to tear these companies down. You may be right.
That's what I thought.
You may be right about some risks. So, and let's talk about shadow banking for a second and the risks there. Now, if it was going to happen, I think it would have happened by now, right? So I'm not saying that China can't ever implode.
Well, what about the bank they just did bail out? The first time since 1989.
And they're going to keep doing that, right?
Yeah.
They watched our banking crisis and they're not going to let that happen to themselves, right?
Oh, for sure, they will bail out.
Yes.
Yeah.
And they will, and what else have we become used to? That the numbers aren't real, right? And we're gonna that story's gonna be going on and on and on, right?
Yeah.
These GDP numbers, even when they come down to 5%, we'll say, oh, that's not real. It's really 3%.
But does anyone think it's 6.2? No.
Has it mattered?
Does it matter for investors?
Has it mattered? Is my point.
Right.
And they will stimulate. They can't help but stimulate. They won't stop to keep that economy rolling. They almost have to.
Yeah.
With that size of population, that middle class. The other theme here that I want to emphasize, and I didn't come up with this on my own. This comes from a fund manager, a Swiss fund manager named Felix Zulauf. In 2017, he predicted that China would be fine entering a slowdown with this trade war. Bring it on, basically. And in 2018, they were like, bring it on, because they're going to take the long view anyway, negotiating against the U.S.,
For sure.
right? They're going to hold off as long as they can on the IP issues, technology transfer. Why would they want an economic slowdown now? Because 2021, in 2 years, is the 100th anniversary of the Communist Party. And they make these long-range visions, right? When we get a new president sets out an agenda with Congress, hopefully, and maybe they get something done over 2 to 4 years. Maybe,
Yeah.
But China, they make these long-range plans. So they want to come into 2021 on the 100th anniversary of the Communist Party looking strong. So they'll take an economic downturn now in 2019 and and then re-stimulate with the big guns in 2020 and come out of it. So that I favor that view because they're very strategic, and so a slowdown now doesn't really bother them. And that's why and I would still be very selective about what Chinese companies I buy.
Okay, that was my next question.
Yeah.
Like, what areas would you?
I would still buy Alibaba.
Okay.
I would like to buy Alibaba at 125 if I could. I don't even know if it's going to get there, so I would be nibbling on it here.
What about JD.com?
No,
What do you think of that?
I'm
No?
just going
That's totally consumer oriented.
Yeah, but I'm just going to stay with Baba as having the strength, sort of as the Amazon of China.
Okay.
All right. So, and let's look at one other fire that, the fire of the trade war. They don't really care. Yeah, it's going to impact select companies. Is it going to take their economy down? Well, as the point I just made, maybe, it creates a bigger slowdown than even they're expecting, but I think they'll be able to ride it out just fine.
What about getting into China by using U.S. companies that are able to operate over there? So say Yum China, you can buy them on the stock market now because they separated out from Yum. They're the largest fast food franchise, or like a Starbucks, they're a big player over there, but we don't know if the trade war continues how much they might be targeted.
I do have a company that I think should be bought on that, and that is the Trade Desk.
Okay.
The digital advertising platform that creates programmatic advertising for all media, television, internet, mobile, you name it. They call it omnichannel, and they, just like Facebook allows you to target advertising, the Trade Desk lets companies do that too, target their consumer, and get attribution. That's one thing I always forget. Attribution is really important. Like, how do I know that this ad caused that person to buy? You need those links, and digitally, it's so easy to do. So if you get attribution data back that, wow, I got this ROI on that ad, that's huge for companies.
Yeah.
And that's why, go on any web page now, you see the ads changing much more often while you're looking at the same page. They're changing right in front of your eyes because companies are buying that. It's a real-time auction going on constantly. It's like algorithmic trading.
But why won't the Chinese government just exclude them? Like, they're already meeting with tech companies over the weekend to say, we might retaliate.
Yeah, I mean, this is a big deal. The Trade Desk, the stock just launched 25% here. In the past few days. They must have inked some kind of deal to be able to go in there.
Yeah.
I'm not saying that the Chinese can't kick them out.
Right.
But these are the guys that I quoted the stat of, over 800 million people on their cell phones, and doing 75% of their engagement with the world mobily.
Right.
That's the Chinese consumer.
Are they in India?
No.
Okay.
No.
Because that's where I believe a lot of investors can maybe shift their focus if they want that many consumers. India also has a pretty big middle class, not quite as big, but pretty big and growing. So there might be, a way to avoid the China play by going.
All right, we've chewed up most of our time here. So I think Tracey brought up a great point about the, China possibly being able to kick any one of their leading companies to the curb or disable them. Something definitely to watch out for. I know Alibaba had some problems, and Jack Ma was no longer the favored son.
Right.
I think that's why he got out of there.
Yeah,
They're like, okay, we want somebody else in there.
Sure.
All right. Thanks for joining us on Agree to Disagree.
Ahead of the Zacks mailbag, here now is this list of recent Zacks Ultimate new additions.
Hi, I'm Kevin Matras, and this is the Zacks mailbag. So the question I picked today is pretty broad, but I chose it because it is perfectly suited for the current market and lets me touch on several different topics. So the question is, what do you make of the current state of the market? Well, first, let me say that I am bullish the market, and I've been unwaveringly bullish for quite some time. This includes even late last year when so many doomsayers were predicting a recession and the end of the bull market. I knew that was nonsense back then and told everybody to buy. Since then, as you know, the market has skyrocketed, and this year it's put in its best start to the year in decades. So it pains me when I hear all of these know-nothing doomsayers predicting the same old recession and bear market lunacy. There is no recession on the horizon, and there's no bear market on the horizon either. Don't listen to those folks. They've been saying this stuff for years, and they would have cost you a fortune if you listened back then, so don't listen to them now. Now, the recent doom and gloom scare is all about tariffs. The U.S.-China trade impasse and the tariffs that followed sent many into a tizzy. But a closer look shows that the first round of tariffs would likely only shave 0.2 to 0.3% off of our GDP, although it would likely knock 0.5% off China's. That number climbs to 0.4 to 0.5% off of our GDP if the U.S. were to levy tariffs on the additional $300 billion it's threatened, and that would likely shave more than 1 full percentage point off of China's GDP. But again, with our full year GDP expected to be around 3% or more, we are starting from a great place. But make no mistake, both countries want a deal, and the market remains optimistic that one will eventually be forthcoming. Now, the next round of hysterics came after the White House threatened 5% tariffs on Mexico if they didn't do something about illegal immigration and pass-through asylum seekers. Once again, the market panicked without understanding the true impact if it were to even happen. Turns out nobody was overly concerned about 5% tariffs. True, the quick acceleration at 10%, then 15%, all the way up to 25% would have had an impact, but nobody expected it to go that far. And within days, the market rightfully became more and more optimistic that a deal would be made and that tariffs would be averted. That optimism was proven correct late Friday night when the administration announced a deal had been reached and no tariffs would be placed. While all of this was happening, many were still convinced that the Fed would increase rates and slow us into a recession. The Fed emphatically put that wrong-headed notion to rest last week, even though they did so numerous times in other ways over the last 6 months, when Fed Chairman Jerome Powell said that the Fed was open to cutting rates if need be. He cited inflation concerns, or should I say non-inflation concerns, and cross-border trade considerations. And while no timetable has been set for when and if a rate cut is coming, the market is pricing in a 97% certainty that at least one rate cut is coming this year, and some are even predicting 2 or 3 cuts. Now, the next round of nonsense will likely be centered on last Friday's employment situation report. They'll point to only 90,000 private sector jobs created last month versus the expected 175,000. But they won't talk about the unemployment rate at 3.6%, which is nearly at a 50-year low, nor will they talk about the 3.1% average hourly earnings growth, which is the best in years. They'll instead focus in on one anomalous data point and tell you that the sky is falling. But it isn't. Just like it wasn't back in February when a 20,000 jobs print had all of the bears aghast. The fact of the matter is the economy is doing great. We have a record jobs market. Corporate profits are at historic highs and climbing, and consumer confidence remains near their best levels of this record bull market. One of these days a recession will come and a bear market will follow, but the telltale signs will be easy to read. GDP will not be increasing, it will be decreasing. Do I really need to remind everyone that the 3% GDP we're on pace for this year is more than twice that of the average 1.48% GDP of the first 8 years of this bull market? A doubling of GDP is not the hallmark of a recession. And jobs growth, which is literally one of the best job markets ever right now, will be on a steady decline and even begin to lose jobs. That's not what's happening now. So don't focus on one report. It's meaningless. And keep your eyes on the smoother averages. That's how you'll know the direction of the trend, because it will show you this. And currently that trend is unmistakably bullish. So when the market pulls back, it can be scary, but put it all into the proper context. The recent 8% pullback in the S&P, and again 10% in the NASDAQ, doesn't seem like such a big deal given the more than 20% gains the market saw in the first 4 months that preceded it. But markets go up and down, typically a few steps forward and 1 or 2 steps back, but that's natural. And a 10% correction generally happens once a year, with 5% pullbacks even more common. So don't flip out the next time the market pulls back. Instead, use it as an opportunity to pick up more of your favorite stocks or brand new stocks on your wish list at even better prices. Because when the market breaks out to new highs, you'll be glad you did. Just keep your eyes on the big picture and shut out the doom and gloomers. These are historic times for our economy and the market, so make sure you're taking full advantage of it.
Sheraz Mian and Neena Mishra handle the portfolio makeover. But first, these interesting insights from Zacks Ultimate Editors.
Hi, this is Sheraz Mian with the Portfolio Makeover segment. With me is Neena Mishra, and we have picked a portfolio from Stephen W., one of the ZU customers. The submissions for this segment are always quite a few, and the reason we picked Stephen's portfolio was because of the interesting components and the size and all of that. Neena has helpfully added it to the Zacks.com portfolio tracker, which we'll share with you guys in a few seconds. So Neena, what do you see in a big picture sense? What stands out to you when you look at Stephen's portfolio?
So when I looked at the portfolio, the first thing that I noticed is that he must be a very happy man today because he owns Tableau, ticker data, which is up 35% today.
Okay.
But there's a lot of concentration in technology stocks today. In general, it is a high beta portfolio, which must have done very well today because markets are up and in the past few days. But it's a concentrated high beta portfolio. That is my observation when I looked at it.
Yeah, no, that's interesting. Actually, you mentioned the CRM data purchase. We don't really know what the individual weightages for these securities are. But as you could see here, as I mentioned earlier, we have it on the Zacks.com portfolio tracker. It's a large portfolio. It has about 35, a little over 35 perhaps names. And as Neena mentioned, it's heavily concentrated in technology. The way I see it, about half of the stocks are in the tech sector. I personally don't have a problem with concentrated positions, even though in a general sense, we always advise our customers to be diversified. It reduces risk and doesn't give you this oversized leverage to movements in one sector. So with respect to this portfolio, my only hope is that this concentration in technology and perhaps under exposure to other area is a function of Stephen's strategy, and he's deliberately and consciously doing it, and not as sometimes is the case when we are just so focused on a bottom-up analysis of picking the best stocks, and the resulting collection of stocks, which are on their own individual merits very well and very good companies, but as a whole, in the aggregate, doesn't give us a diversified picture. So very good quality names, Apple and Amazon and Adobe and Microsoft. And obviously you mentioned data earlier. So a lot of very good quality names. What is some of the areas that you feel, Neena, are missing here?
So looking at the portfolio, and as you mentioned, a number of well-known solid companies in the portfolio, but high beta portfolio, like he has no exposure to finance, traditional finance. There is only one fintech companies, MasterCard. There are healthcare names, but that too mostly biotech and biomedical companies. No traditional boring healthcare companies, which provide stability to portfolio when the markets are volatile. There are at least 5-6 Chinese companies, which are again very volatile. You see Baidu, Baozun, and IQ, JD.com, Tencent. There are a number of companies which went public recently in past 2-3 years. Nutanix, Twilio, Okta, Upworks. And these are, I'm not saying these are bad holdings. These are all very companies with a lot of potential, but they are more volatile than traditional established companies. So if he's a person who is watching his portfolio carefully, then it's fine. If he understands what he owns, then it's fine. But for most investors, I think a little more diversification would be required. I do see there is one ETF in the portfolio, the Vanguard S&P 500 ETF. This is the cheapest ETF, which provides exposure to the S&P 500 index. So that's a good holding, which provides stability to the portfolio.
And I think the lack of finance is very obvious to me as well, and I would second your opinion there. Energy is not there, though energy is doing so bad recently that perhaps he's better off in that. Finance itself is not doing too good either, but it is such a big chunk of the S&P 500 and also the small cap indexes that staying out of that big area really is a hit on the overall diversification. But if we look at this portfolio as a whole, it appears as more techy, more growthy kind of portfolio. And as long as that's his strategy, it appears to be a pretty good execution of that strategy.
Exactly. If he's a risk-averse investor, or for any risk-averse investor having a portfolio exposure like this with a lot of exposure to high beta, high growth names, I would suggest maybe adding a value ETF to provide some value to the portfolio. And he has a lot of exposure to those Chinese companies, which did not do very well last year, late last year, and earlier this year when they were beaten down because of trade war concerns. So instead of having exposure to maybe individual Chinese companies, for people who do not understand international companies very well, having an international ETF on an emerging market ETF is a better idea for having diversified and low cost and low risk exposure to those kind of international companies.
No, very good, very good. Well, thanks, Neena. Well, thanks, folks, for watching. That's it for this segment of the Portfolio Makeover.
Here are a few things you can expect to see coming up. Keep an eye out for 2 new reports which will be posted on the Zacks Ultimate homepage soon. The latest 5 stocks set to double report, which features 5 long-term trades our experts predict could deliver gains of 100% or more in the year ahead, and a special report centered on sports betting, and that's written by David Boren. And remember, the next Zacks Ultimate Strategy session will be posted in early July, so start thinking now of those submissions for the Zacks Mailbag and Portfolio Makeover segments.
My top pick is the trade that got away. And you know what I'm talking about, the trade desk. We were supposed to buy it under $200 during the pullback we had to S&P 2750, and I fumbled that trade. But this is a company making new highs today above 250 that we still want to try and get in on pullbacks. And I'm going to give you the rationale why this could be easily a $300 stock this year. First of all, let's look at the total addressable market that the trade desk is going after. Remember, this is digital programmatic advertising. They are, when you're looking at a web page and the ad changes every 15 seconds or 30 seconds, that's the trade desk technology doing that. So total global ad spending you see is $725 billion. Digital advertising will keep pushing into that. And remember that when we talk about Facebook, the Goliath that it is in digital advertising, or Google, those are silos. Those are walled gardens. The trade desk is going everywhere to 100 different platforms and websites across, they call it omnichannel. Let's look at why they say we buy the whole internet. Here's where your ads could be placed. They give you the platform and the tools to help you target your audience and then pinpoint with precision your ad spend to your audiences, where you could be showing the same ad 1,000 times a day in 100 different places. All right, last thing we want to look at is what's the growth like. Here's the revenue growth. It's occasionally going to be lumpy, like we saw from Q1 to Q2 this year, but the growth is still, above 30%. The trade desk is a stock that you want to own for a long time, especially because they've just gone into China. And China is not only the largest middle class, but they have the largest population actively using their mobile phones and shopping and or locating, finding their people and the places they want to go, and the ads get in front of them there. All right, thanks for joining me.
What kind of stock can you invest in to avoid the trade war? Well, there's not many, but online dating might be one of them. So online dating, huge area. And yes, it can be international. Match.com is international. Tinder is overseas, but there's no tariffs on these kinds of things. So really, online dating has not seen any impact from any of kind of the trade war worries. And match groups got all the big names, as I said, Match.com, OkCupid, Tinder, Hinge, Plenty of Fish, and on and on. So what do the actual fundamentals look like? Very solid on these companies because it's still really popular to find love online, and they're growing earnings at a little over 20% this year and close to 20% expected for next year. You can see the earnings growth here on the chart, kind of matching the stock growth. Now, it's not cheap, trading at 37 times now, but you are buying a growth stock here. Sales revenue expected to go up about 16% this year and next year. So that's a nice little growth trajectory. And again, you are avoiding the trade war issues with Match Group. So I really like this stock. I'm sad it's not a little bit cheaper in valuation in the PE. But again, if you're a growth investor, Match Group, MTCH, is a great stock to look at for 2019.
Well, that's it for another edition of the Zacks Ultimate Strategy Session. We hope you found it interesting. Feedback is always welcome. You can send that feedback to mailbag@zacks.com. Don't forget, if you have questions about the Zacks Ultimate service, you can always contact your account manager at ultimate@zacks.com or by calling 888-775-8348. International callers, you use 312-265-9309. And until next time, thanks for watching. Thanks also to our production crew. And as always, we look forward to sharing success with you for many years to come.